Most financial advice fails in a quiet way, not because it is malicious, not because it is intentionally misleading, but because it is designed to explain behavior, not outcomes. That difference seems small, but inside a financial system, it changes everything. Most financial advice sounds correct the first time you hear it. Spend less than you earn. Save consistently. Avoid unnecessary debt. Invest for the long term. None of these statements are wrong. They are logically clean, easy to understand, easy to repeat, easy to teach. And that simplicity is exactly why they spread. Simple rules create psychological comfort. They reduce complexity. When money feels confusing, people look for rules that make the system feel manageable. Financial advice provides those rules. It creates the impression that the system is understandable. Follow the rules. You will be fine. If you are not fine, then something must be wrong with your behavior. This is where the narrative quietly forms. Success becomes a reflection of discipline. Struggle becomes a reflection of personal decisions. But the financial world does not operate inside simple rules. It operates inside systems, and systems introduce forces that advice rarely explains. Inflation slowly reshapes the value of money. Asset prices move independently of wages. Tax structures reward some behaviors while punishing others. Capital moves through markets in ways individuals cannot control. These forces operate constantly in the background. Most people never see them directly. What they see instead is advice. Advice sits on the surface of the system. Clean, simple, comforting. But surface rules can feel correct while ignoring the structure underneath. Saving money is responsible. But saving money inside a system where purchasing power declines every year is not the same thing as building wealth. Working hard is admirable, but labor income behaves very differently from asset ownership over long periods of time. Avoiding debt sounds cautious, but in certain environments, leverage becomes the mechanism that allows people to acquire appreciating assets. The advice itself does not change. What changes is the system surrounding it. And when the system changes, advice that once worked can quietly stop producing the same outcomes. This is where confusion begins. People follow advice that sounds responsible. They save, they budget, they avoid reckless spending. Yet, over time, the results do not match the promise. The gap between effort and outcome slowly appears. At first, it feels personal. Maybe the savings rate wasn't high enough. Maybe the discipline slipped somewhere. Maybe the strategy simply needed more time. So the solution becomes more of the same advice. Save more. Cut more expenses. Work harder. But repeating behavior does not change the structure surrounding it. And this is where the deeper problem begins to appear. Most financial advice is built around individual behavior, while the outcomes people experience are largely shaped by the system itself. Financial advice almost always your habits, your spending. The message is simple. If you behave correctly with money, your financial life should gradually improve. Spend less than you earn. Save consistently. Invest patiently. These ideas frame money as a behavioral problem. If the outcome is good, the behavior must have been correct. If the outcome is disappointing, the behavior must have been flawed. This interpretation feels logical, but it quietly ignores something important. Money does not exist only at the personal level. It exists inside an economic structure. That structure moves continuously. Interest rates rise and fall. Housing markets expand and contract. Currencies lose purchasing power over time. Asset prices inflate. These forces operate whether an individual behaves responsibly or not. They are not controlled by discipline. They are shaped by the design of the system itself. This is where the gap between advice and reality begins to appear. Advice focuses on personal decisions, but financial outcomes are heavily influenced by systemic conditions. Consider something simple: saving money. Saving money is responsible behavior. It creates stability. It creates flexibility. It creates a buffer against unexpected events. But inside an inflationary system, saved money slowly loses purchasing power, year after year, quietly. The behavior is responsible, but the system reshapes the result. The same pattern appears in other areas of financial advice. Working harder increases income, but wage growth often moves slower than asset inflation. Over long periods of time, housing prices, equities, and other assets can rise faster than wages, which means labor alone struggles to keep pace with the system. Again, the behavior is not wrong. Working hard is productive, but the structure surrounding that labor determines how far the income can actually go. This difference between behavior and structure is rarely discussed in everyday financial advice, because behavioral rules are easier to communicate. They fit inside short sentences. They sound responsible. Structural explanations are more complicated. They involve economic incentives, market dynamics, institutional behavior, long-term financial cycles. These forces are harder to explain in a simple rule, so they are often left out entirely. The result is a form of financial advice that is technically correct, but structurally incomplete. People are told to improve their habits, to reduce unnecessary spending, to increase savings. But very little attention is given to the environment those habits exist inside. For example, asset ownership behaves very differently from wage income. Assets participate in market appreciation. Labor income typically grows slowly and requires constant effort. Over time, this difference compounds. Those who own appreciating assets benefit from the system's expansion. Those who rely only on wages often experience a slower form of financial progress. None of this means discipline is irrelevant. Responsible behavior still matters. But behavior alone cannot fully explain financial outcomes, because the system surrounding that behavior is constantly reshaping the results. And once that becomes visible, the way financial advice is interpreted begins to change. Advice that once sounded complete begins to reveal the structural layers it never mentioned. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Financial advice also carries another quiet assumption. Most common financial rules were shaped during specific economic periods with different conditions, different asset prices, different relationships between income and cost of living. Advice travels through time, but the system does not stay the same. Decades ago, a single income could often support an entire household. Housing prices were lower relative to wages. Education costs were far smaller. Saving a portion of income and gradually investing it could create meaningful financial progress. The environment supported that strategy. But systems evolve. Housing markets expand. Urban populations grow. Asset prices inflate. Currencies lose purchasing power. And when these structural changes accumulate, the environment surrounding financial advice begins to shift. What once worked smoothly inside the system may begin to behave very differently. Consider housing. In many places, Housing prices have grown faster than wage growth over long periods of time. This creates a widening gap between labor income and asset ownership. A rule like save patiently for a home can quietly become harder to execute as prices accelerate faster than the ability to accumulate savings. The advice itself has not changed, but the system surrounding it has. The same pattern appears with education. Higher education was once a relatively modest financial commitment. Today, the cost structure has expanded dramatically in many regions. Advice like invest in your education remains logically sound, but the financial equation behind that decision has become far more complex. Debt levels, expected income, economic demand for certain fields, all of these variables shape the outcome. Yet advice often remains frozen in older assumptions. It continues to present the system as if the underlying conditions have not moved. This creates a time mismatch. Advice designed for one economic environment gets applied inside another, and over time, that mismatch becomes more visible. People follow rules that once worked, but the results begin to feel different, slower, more uncertain, harder to achieve. This is not necessarily because individuals are behaving incorrectly. It is often because the structure surrounding their decisions has changed. Financial systems evolve through policy changes, market expansion, technological shifts, global capital flows. These forces reshape opportunity over long periods of time, but everyday financial advice rarely updates at the same speed. It continues repeating familiar rules. Spend responsibly, save diligently, invest over time. All reasonable ideas, but ideas that assume the surrounding environment behaves the same way it once did. When the system evolves faster than the advice describing it, confusion naturally follows. People begin to feel that they are doing the right things, yet the progress feels slower than expected. The explanation often returns to personal discipline, but discipline is only one variable. The structure of the system itself is the other. And when the structure shifts, advice that once felt reliable can quietly begin producing very different results. At this point, the question becomes clearer. If the advice sounds responsible, and the behavior is not necessarily wrong, why does the outcome still feel misaligned? The answer often sits in a quiet distinction. The difference between advice that sounds responsible and strategy that actually works inside a system. Financial advice is usually built around behavior. Spend less, save more, avoid mistakes. These ideas focus on stability. They help people avoid obvious financial harm. But stability is not the same thing as progress. And progress inside financial systems tends to follow a different set of dynamics: ownership, scale, compounding. These forces operate very differently from simple budgeting rules. Budgeting protects resources. Ownership multiplies them. Saving money preserves value in the short term, but ownership allows capital to participate in the growth of the system itself. This is the structural shift that most advice never fully explains: the difference between protecting money and positioning money inside systems that expand. Economic systems constantly generate value through businesses, markets, and assets. Equities appreciate as companies grow. Real estate appreciates as cities expand. Infrastructure produces ongoing cash flow. When individuals participate in these ownership layers, they are no longer only protecting income. They are participating in the system's expansion. This is where the conversation quietly changes. Financial advice built only around discipline treats money as something fragile, something that must be protected from mistakes. Strategy, on the other hand, treats money as something that can be positioned, placed inside structures that grow over time. This does not eliminate risk. Every financial system carries risk, but it changes the role money plays. Instead of simply managing consumption, the focus begins to shift toward participation in economic growth. And this is where the limits of traditional financial advice begin to show. Because most advice is designed to help people behave responsibly with money, not to explain how financial systems actually distribute wealth. Understanding the system requires a different lens. It requires looking beyond individual behavior and asking deeper questions. Who owns the assets? Where does capital flow? What incentives shape the market? Once those questions become visible, the advice itself starts to look different. Not necessarily wrong, but incomplete. Saving still matters. Discipline still matters. Avoiding reckless decisions still matters. But those behaviors alone do not explain why wealth accumulates in certain places within the system. That accumulation follows structural patterns, patterns driven by ownership, leverage, incentives, and time. And seeing those patterns changes the way financial advice is interpreted. Advice becomes a starting point, not the full explanation. Because understanding money ultimately requires something deeper than simple rules. It requires understanding the system those rules operate inside. The system does not reward behavior alone. It rewards positioning. And once that becomes visible, financial advice begins to sound very different. If this changed how you see the system, subscribe. Like this if it clarified something.